The most important driver for the Indian markets in the next 12 months is the cyclical recovery, mainly in consumption, that is being slowly built in the second half of this financial year. That the primary driver of that is the monetary stimulus that has come in from the RBI, and we are fairly confident that come the festival season, one will start to see better consumption numbers, especially on the discretionary side. And in fact, on the non-discretionary side, we are already seeing reasonably good numbers starting to come in at this point. So, yes, there may be short-term volatility around the tariff news, but the most important part is, do we see a cyclical recovery in the second half in India's domestic economy?
Oh, yeah, absolutely. And, hats off to the central bank. They've done all that they could have with that bazooka that they actually fired last time around. And perhaps a little bit more could also be in the offing. But that's, of course, the one part and the global aspect of it all. Domestically, Seshadri, what is it that you're making of the earnings? Because they seem very... case by case now. There is not one sector which does well. It's few companies within each sector.
Yeah, the earnings isn't really bad. I mean, we went into the earnings season expecting a weak quarter. The macroeconomic impulses that we were tracking through the last quarter weren't very good, and therefore it was fairly logical to expect a reasonably weak earnings season. And the market also was gearing up and prepared for a not very exciting earnings season. In that context, the season has not been that bad. In an absolute context, I think the numbers are still fairly weak, but in the overall versus expectations, we haven't seen a major negative surprise. And the proof of that pudding is that forward estimates for both Nifty and the broader market have not taken a beating as they did between, say, October and April, October last year and April this year. So the earnings season is weak, but not very worrying at this point in time. Yes, there is a lot of expectations pinned on the second half recovery at this point in time. And you're right, in between all this relatively weak earnings, there are pockets where we are seeing a lot of positive surprises come in, and stocks are reacting to those events. Those are aren't really broad sectoral trends, but individual companies more in the small and mid cap space.
All right. Hi. Good morning, Mr. Sen. This is Srishti also joining in. But when you say that the earnings are not that bad versus what was expected, rather, why don't you help us understand the sectors that you're pinning hopes on? Because this time, the IT sector, if we say, nothing much has happened there in terms of the banking counters as well. We have seen some disappointments. It seems like it's the auto and the FMCG counters that are doing pretty well. Any adjustments do you believe that you will be willing to do in your portfolio, taking cues from the earnings?
We remain, the earnings season has reinforced our overall sectoral view, where we have maintained that sorry, just give me a minute. The overall sectoral view, where our top overweights are financial, consumer discretionary and industrials. And this result season has actually not suggested anything that we should change that view. Industrials, in fact, some of the companies, especially power equipment, etc., have delivered fairly positive surprises in terms of overall numbers. On the consumer discretionary side, while the numbers have not been exciting, there have been pockets of fairly strong positive surprises, despite the overall growth environment not being that constructive. So, to repeat, our top overweights are consumer discretionary and industrials, and these earnings season reinforce that. We have been negative on and underweight on financials for quite some time, and the financial numbers overall have been fairly mixed. As far as FMCG is concerned, it's a sector we would stay away from because there's a structural negative adjustment going on there. Valuations are not that attractive that you want to jump in and take a risk there.
Sure, Mr. Sen, just want to probe a little bit more on that FMCG point that you were just making. Now, we are hearing that there are some green shoots in terms of a slight bit of a recovery in urban. Rural still continues to outperform. Maybe if not the entire staples basket, would you be willing to give a relook to some rural focusing themes and some companies that have a lot of rural exposure, given that strength continues to to be built in that segment?
Yes, in terms of a top-down theme, that appears to be attractive, but there is plenty more going on in that sector, so I would stay away. In general, you will see that stock price performance in FMCG stocks happen when there is margin improvement. Volume growth usually is not that important to trigger. Secondly, there is a structural change in the overall way the industry behaves, and I think both on the advertising side and on the distribution side, there are a lot of changes which are narrowing the moats for many of these companies. So, trying to play a small rural bounce in that context is a little risky, in my opinion. I would stay away. Yes, there could be a short term trade based on the rural bounce on rural heavy companies. But until I see a clear path to them reacquiring pricing power and being able to improve margins, I would stay away from the sector. And very frankly, despite all the commentary around the positive rural recovery, I don't see that. I don't see a pathway to improving margins.
Interesting. So, what's looking like a sector which has moat around itself right now, Seshadri, and is completely aloof or decoupled in that sense from the global moves?
I'm a little averse to the word decoupled. Nothing is decoupled. If there is a really major global turmoil, we've seen many times in the past that India will not. So, with that caveat, there are three sectors which I think are on a structural upswing. And in my model portfolio, those three sectors I've said in my last note are permanent themes, and I will always stay invested. The first is internet. And we are, across the internet space, adoption is improving. Some of those business models are evolving, and many of the companies are doing very strong execution in that space. The second is EMS, where I'm a recent convert. I think the growth there is fairly strong. I'm not sure that the tariff regime will upset that industry, because a lot of it is import substitution, which is relatively unaffected by tariffs. And there's a long pathway of growth, because domestic production of as a percentage of India's total electronics consumption is still fairly low, and that number will only keep going up, aided by very positive government policy. The third is airlines, where we're adding two new airports in the MMR and in NCR within the next 1 year. There is a global shortage of new aircraft, so the incumbents will continue to grow and gain market share and get pricing power. Valuations don't really reflect that entirely. So these are the three themes that I think are sort of immune to short-term volatility and short-term cycles, where we are looking to stay invested.
Right. And it's funny how the word decoupled comes back every decade, right? Okay. Seshadri, great to chat with you. Thanks for your time today.